Good afternoon, everyone. I'm Andy Kelly. I'm an expatriate tax partner in our London office, and I'd like to welcome you all, both members of Expat Academy, clients of BDO, and all to this afternoon's webinar. As advertised, we will be doing a global tax clinic, and I'm very fortunately joined by a number of my international colleagues on this call today. So in the course of the clinic, you'll be hearing from Peter Weitz from our Belgian office, Cyril Kleger from our French office, Robin Schalkamp from our Netherlands office, Deborah Moses from BDO Canada, Brad Velkamp from BDO USA, and last Stuart Strong, who's my colleague from the London office. We'll each of the participants will be speaking without slides, but we will be circulating notes of the webinar within a couple of days of the session alongside the recording. I would invite you, as we are doing the presentation, we've got a number of people that have submitted questions in advance of today's session, so we'll be aiming to cover those at the end of the presentation. If you have questions as we go along in relation to each of my colleagues' sections of the webinar, please do type questions in, and I will pose those questions to my colleagues after they've completed each of their respective sections. So without further ado, first I will introduce my colleague Peter Weitz from BDO Belgium and invite Peter to talk to us about issues that he's observing and tax trends in Belgium at the moment.
Thank you, Andy, and good afternoon, everyone. So my name is Peter. Indeed, I'm joining you from Belgium, as you know, very strategically located on top of the FIFA World Ranking, but also in the heart of Europe. We are a very small country with a very open economy. A lot of our people cross the borders for their work. Likewise, we have a lot of foreign residents coming to work in Belgium on a daily basis, and that has been a little bit different over the last couple of months, obviously due to the COVID lockdown first and then the travel restrictions that we had. So a lot of these commuters, the daily travelers, were forced to work from home, and that brings a lot of tax and social security questions with them that we are dealing with on a daily basis these days. The basis for the discussion is obviously the double taxation agreements in place between Belgium and various other countries. And as you all are aware, physical presence is really the key factor to determine where a person is taxable. And basically, due to the lockdown and the travel restrictions, people have spent more working time in their home country, and that potentially increases the amount of income that will be taxed in their home country, and less income will be taxable in their host country. Now, this is not necessarily a bad thing, but if you look at it from a Belgian point of view, we have very high tax rates. So Belgian citizens pay up to 55% of tax on their income, and most of them are very happy if part of that income is taxable in another country, because it will be taxed at lower tax rates. So being taxable abroad is one of the most popular tax planning ideas that we have in Belgium. And therefore, the COVID-19 and travel restrictions have had an impact on people's net income and their overall tax burden. And that's why the Belgian tax authorities have also been very active in negotiating special agreements with neighboring countries, the Netherlands, Germany, Luxembourg, and France, to come up with a solution for that. And the solution was found in signing temporary agreements. Temporary meant agreements from mid-March till 1st June, then September, now the end of this year. On the basis of which, so on the basis of these agreements, the employees and employers could opt to be taxable in according to the working pattern that's laid down in their employment contracts, regardless of where their activity has effectively been taken place. So basically what's happening there is that employers and employees can opt to ignore the lockdown and travel restrictions and be taxed in accordance to the physical presence that would normally have taken place had there not been any restrictions. So that's of course a very important agreement that has been reached. And we are now currently discussing with a lot of companies and our clients to see how that fits to their internationally mobile workforce to reach the best possible solution for all. I just mentioned there's agreements with 4 neighboring countries. It also means that if no special agreement has been reached with a certain country, for instance the UK, then the standard rules as included in the standard agreement remain into force, and that means that taxation will follow physical presence. Now, in addition to tax, there's also social security, obviously, and there very early in the COVID lockdown situation, the European authorities had reached an agreement and stated that also for the application of the EU regulations on social security, abstraction was made from the lockdown and the travel restrictions, and people can remain covered by the social security scheme that applied prior to COVID-19. So the changed working pattern during the COVID-19 situation will not impact them and will not result in a change in social security system that applies to them. So that's a very important element, again, very important to our clients and their employees, because social security obviously is a very important matter, and the authorities have luckily agreed that the interest of the employees should prevail, and that therefore no unnecessary changes were to be expected and should be implemented. Apart from COVID-19, another important topic that we are that's important in Belgium, that's taking a lot of our time these days, is the new rules with respect to withholding tax. Historically, in Belgium, what happened when you assigned someone from a neighboring country to Belgium, when you assign somebody to a group entity in Belgium, typically no withholding tax was required. So you could keep these people on a home country's payroll, apply social security, and then pay your Belgian taxes when you filed your income tax return and got your tax assessment in. Now, this changed in the first step early last year in 2019, where the authorities implemented new legislation stating that Belgian companies were obliged to withhold taxes on benefits. Typical example, a share scheme operated by the parent company abroad. So when you provided benefits to an employee of the Belgian entity. So the Belgian entity, since last year, is obliged to withhold taxes on that benefit, even if that benefit was not provided by the Belgian entity. Now, earlier this year, the Belgian tax authorities published more guidance. They published a frequently asked questions guide. And on the basis of the wordings and the interpretations in that guide, it has become clear that withholding tax will now also be required on wages paid by seconded employees, employees seconded to Belgium. Previously, this was not the case, as there was no formal employment link between the Belgian entity and that employee. And now a fiction has been created, as the result of which the Belgian entity, the Belgian company, will be obliged to apply withholding taxes on that salary as if it was the Belgian company that provided that salary to the employees. So that's a very important change that came in earlier this year. And we're working towards year end to make sure that clients and companies are compliant with this new requirement to operate shadow payroll and run and apply withholding taxes in Belgium. Another topic that of course is very imminent is Brexit. A lot of questions there. That probably comes up during the next part of the session anyway, so I will not comment on that for the time being. But if you have questions on Belgium's Brexit position, then I'm obviously here to answer those. So for the time being, I'll pass back to you, Andy.
Yes, thank you there, Peter. So we have got one question that's come in respect of Belgium. So you mentioned in your in the presentation part that the employees have the possibility to opt for a taxation on the basis of time they would have worked in countries rather than the actual time. It was just around what the obligations on the employer are. Do they then need to withhold on the basis of this election or this option by the individual?
That's a very good question, and indeed, the individual's decision may affect the obligations for the employer, and that's why the Belgian tax authorities have issued an administrative circular letter in which they also mentioned that if employees decide to opt for a taxation based on not the actual physical presence, but the historical physical presence, if I can call it that way, they should sign an agreement with their employer in which both, in fact, confirm that this will be the position that will be taken. So the employer, by default, will be aware of the employee's decision and therefore can take the necessary steps to be compliant on a withholding obligation. So where in theory it is the individual's decision to opt or not to opt for the possibilities provided by the treaty, in practice it will be a joint decision because the employer will be involved in that process as well.
Great. Okay, yeah, thank you there, Peter. Very clearly answered. Thanks. So next, I'd like to introduce Cyril from BDO France, and I'll hand over to Cyril to do a section on the status of tax matters in France.
Good afternoon. So with regard to France, we also have some specific rules with regards to the cross-border workers. As Peter explained, it's a crucial issue for many European countries, including France. France has border with 8 countries and has more than 400,000 people who live in France and work in border countries. The OECD has made some comments in April with regards to the COVID the COVID situation for cross-border workers, saying that because of course of exceptional circumstances, there should be a coordination between countries to mitigate the compliance and administrative costs. So France has signed some agreements with most countries, border countries, with Belgium, with Germany, with Luxembourg, with Italy, with Switzerland. And these agreements were applicable until the end of August. The French tax authorities recently announced that these agreements were being extended up to the end of 2020. And the principle is, as Peter explained, is that basically we should not take into account days which are spent in work from home in one country for the application of the rules. And that's, for example, the case with Luxembourg. With Luxembourg, we have a limit of 29 days per year that can be spent in France without any taxation. And so based on the agreement, for example, there would be no taxation in France, even if this limit is exceeded because of the COVID situation. Then we also have a lot of situations which are not cross-border situation, but which are commuters. That's the case with the UK or many other countries within Europe, and these situations are not covered by the agreements, and so we should normally apply the standard provision of the tax treaty. But it's sure that because of these exceptional circumstances, there will be some flexibility of the French tax authorities with regards to this situation. And that leads us to another point, which is the tax withholding in France. As you may know, there was a change in the tax system from 2019. France implemented the tax at source. And this is also an issue for foreign employer. And with the COVID situation, we have employees working in France from home and who have foreign employers. And now, and this is new since last year, the foreign company would have, in most cases, to withhold taxes, and the process is quite complex. The company would have to register in France, would have to appoint a tax representative in France. It's necessary that the company would have a bank account, a SEPA bank account, and to file monthly tax returns. So it's important, if you have employees in this situation, that you analyze this situation. And also you might need to file a posting declaration, which is called CIPSI, which is not a tax declaration but a labor law declaration. One last point is about equity plan. You may know that in France we have both what we call qualified plans and non-qualified plans for stock option and share awards. The French qualified plan are outside the scope of the French tax withholding, but that's not the case with the non-qualified plans, which are subject to the withholding obligation. And so it's very, and because the system of the French tax withholding, the calculation of the French tax is due on an individual basis and is provided by the tax authorities to the French employer. We have an issue for foreign issuer because there is a prohibition for the French employer to provide the tax rate to the foreign issuer, which should make the tax withholding. So this is also an issue you must be aware of, and it requires also some analysis. And last point about the equity plans, there have been some changes in France on the French qualified plans. About the conditions are now more, I would say, there are less conditions to have a qualified plans. The vesting period are shorter than they were before, and it might be more tax efficient today to have a qualified plan. So it might be worth having to look at your equity plans and to analyze whether it would be interesting to implement a French plan in your situation. Okay, so Andy, I don't know if there is any question.
Yes, so there's one question that you'll see is published on the Q&A. Okay. Yeah, just for the benefit of it, to make sure it can be viewed by all. So it says, has France agreed no taxation for UK employed individual? And this person has a French national working in France due to COVID, but is employed in the UK. Okay. Yeah, no, there are no specific provisions or concessions for between France and the UK. So so the first issue, of course, would be to analyze the tax residence, whether this employee now working in France would be considered as a tax resident, and if it's only for a short period or it will continue. But then anyway, then we apply the provision of the tax treaty, and so if the employee is French tax resident, there will be a tax withholding obligation, and the employer would have to, so the employee would have to pay taxes in France. If the employee is not resident in France, there still may be some taxation in France if the employee is spending more than 183 days in France. Great, thank you very much, Cyril. So I'd now like to introduce our next speaker from BDO Netherlands, Robin Schalkamp. Just checking we still have a connection with Robin.
Yeah. Yes, can you hear me now?
Yes, yeah.
Oh, sure. Yes, I was already talking. Well, I was saying, sorry for the confusing. Well, today is a very special day in the Netherlands. My name is Robin Schalk. I'm from the Netherlands, and today is a very special day because today is budget day in the Netherlands, and the government is announcing new rules, new legislation for the next year. And every third Tuesday of September, this is the day budget day, and today is the third Tuesday. Anyway, normally it's in a day with all kind of festivities, but because of the COVID, well, it will only a formal day with formal legislation that will be announced. For now, I will inform you a little bit about the Dutch regulations with regard to the COVID, and Peter and also Cyril already told a little bit about it. Also, the Netherlands have concluded additional tax treaties with our neighbor countries, and our neighbor country, I mean Belgium and Germany. So not with the UK and not with the US until this point of time. And in these treaties, what has been agreed is that the tax, the right to taxation for the countries will remain the same as if the employees would have worked in the pattern before the COVID. So as Peter said, working from home will not influence, if the employee choose for it, the tax position of the employees. However, well, this is a very, very relevant issue, because if the employees could choose, so if the employees choose, well, to not make use of this specific regulation, then the home country, assuming that he's working from home, will have to right to tax. And well, whether or not this will be beneficial for the employer, well, that's that could that's dependent on the actual facts and circumstances. But that's the thing. The employee could choose, and according to the current tax treaties, the employees could choose when filing an income tax return. So that's very relevant for companies, that after the tax year has been ended, there could be there could be a need to change the payrolls for the year before. That's one of the things. Another thing is that's based on our national legislation to attract to influence the companies to employ employees in this uncertain times. We have a certain regulation. It's called the work cost regulation, and under this work cost regulation, it is possible for employers to reimburse 1.2%. That was the base of the total wage sum tax-free to the employees. Starting 2020, the percentage has been increased up to 1.7%. However, during the COVID period, the percentage has been increased even more to 3%. So 3% up to a maximum of 400k could be reimbursed tax-free under certain conditions. So that is in a regulation to make it more attractive to employees. The third thing I want to mention is that it is possible for companies that have employees, but also for employers without employees, to file an application with the Dutch tax authorities to extend the paying deadlines for tax returns. So this is valid for the wage tax return, corporation tax return, but also, for instance, for the VAT returns. And this is also meant, as a measurement to increase the cash flow position of the companies in the Netherlands. So this is in very short the three, I do think, most relevant consequences, the most relevant regulations that have been in place since the COVID period in the Netherlands. I go back to you, Andy.
Yeah, thank you there, Robin. That was really useful. Thank you. So one question that we had submitted in advance of today's webinar was whether if employees of overseas companies, so foreign companies, are choosing to return to the Netherlands and work from home in the Netherlands, in what circumstances could there be the need for the foreign employer to have to register to withhold Dutch tax?
Yeah, that's a good question. In the Netherlands, there is a registration. There could be a registration obligation with regard to two items. On one side is the social security premiums, and for the other item is the wage tax. For the social security premium, as Peter also already mentioned, the change of the working pattern due to the COVID doesn't have to change the position. So as a consequence, it also doesn't change any possible need to register the company as a withholding agent in the Netherlands. Of course, in case the company would have an obligation before the COVID, it will remain in place. That's the side. That's the social security part. And for the wage tax, well, there could be an obligation to register and well, to act as a wage withholding agent in case there is a PE, permanent establishment, in the Netherlands. And well, the main rule is, in case the employee is working from home and there is no office, well, there could be all kind of circumstances, of course, but let's say the main rule is that a home office, if someone is working from home, that doesn't create a permanent establishment in the Netherlands for wage tax purposes. So as a consequence, as a main rule, well, there won't, well, in case the employee is going to work from home because of the COVID, it doesn't change the possible registration for the employer.
Yeah. Okay, thank you. I see there's another question on the Q&A. Robin, when we come to the end, I'll pose you this question that was posted about the 30% ruling. So I'll make a point of coming back to you at the end to address that question after the other presenters have spoken.
Yes, perfect.
Okay, thank you. So like I say, that question will be fielded later. So I would now like to introduce sort of moving geographically from Europe over to Canada, where we're kindly joined by my colleague Deborah Moses.
Hi, and hope everybody is doing well in this time. Similar to some of my other colleagues that have spoken, the Canada Revenue Agency has issued certain administrative policies, and in September they changed it again. There's similar to what Robin was talking about, that if you have somebody that has been solely related to travel restrictions and stranded in your country, that is one thing. But if there's a person who actually decides on their own to move from, let's say, in most cases we have Canadians living abroad in the US, and they choose for personal reasons to return to Canada and work remotely, typically from a home here that they may have, but they're continuing to work for their US employer. Under the current Canada Revenue Agency guidance, what they're saying is that individual was not initially stranded in Canada, but rather chose to proactively leave the US and return to Canada. So there's different rules that they have in place there. They introduced some protection measures for the COVID to help people when they were stranded in Canada. But if somebody voluntarily comes back, the normal rules will apply. So there's ones in particular, Canada has a very strict payroll withholding for companies. So if a foreign company has somebody in Canada for 1 day, there's an obligation of the employer, the payer, to withhold payroll taxes in Canada on the first dollar earned in Canada. So it's very strict rules. We do have some waivers that come in, but they have protected people where the person is stranded. We do have these waivers that have been in place, and some of them have day limits on them that unfortunately, because of the COVID and people getting stuck, they end up being stuck in Canada longer and could put the waiver offside, but they have provided relief in that way that they will protect them. But if they're people that have come in and on their own, that they have to be careful because the payroll obligations could come into play there. So it's very tricky that they have to watch what they're doing, and if they're able to say that the person was under the waiver and that they're stuck in Canada due to travel restrictions, that should be okay. But if they're somebody that was living in the US and decided to come back to Canada and continue working for the US employer, it would not work. So it's just to be careful of the payroll obligations. The other part is that there's very strict rules on the individual's filing obligation in Canada, whether or not they're able to get exemption under the treaty. So similar to other countries, what Canada has agreed to is that if the person is stuck in Canada solely because of the travel restrictions, that those days will not count towards days as employment in Canada. But it's a matter of, again, having to determine whether or not you have people coming back voluntarily. If people come back voluntarily, we have a rule in Canada, a soldiering rule, which means that if you're physically present in Canada for more than 183 days, that you'd be considered a tax resident for the entire year. So it means even though you're only here for 6 months, you would actually get taxed on the entire year. So if the individual fails to meet a residency test in their home country, like for example in the US, they have a substantial presence test. So if they were meeting a substantial presence test in the US to say that they're a domestic resident there and they fail it because they left, and then they would not be considered resident and we couldn't use the treaty. So we have to be careful of certain things like that. But it all depends on whether it was somebody that was stranded or somebody that voluntarily went back to the country. So, and there's various issues with having to make sure that you look at the PE issues as well, to make sure that there's no person coming into Canada that could be tripping that up. So, Andy, I'm not sure if you had any questions come in.
Yeah, we had a question that was posed in advance about Canada. So you obviously talked about the withholding obligation that can be on foreign employers, and I guess a lot of that could be US companies. But is there any de minimis time that any de minimis time that a Canadian citizen who's employed by a foreign company can spend in Canada before they trigger a withholding obligation for their foreign employer?
Well, the trigger is under domestic law, it's day one. So there's no, it's actually on day one, and it doesn't matter whether they're a Canadian citizen or not. It can be any person performing services in Canada. So it could be anybody from anywhere in the world. The first day it's subject to payroll withholdings by the corporation, even if they would be exempt. That we do have various waivers that could be used, but it's more difficult to get them applied for at this time.
Okay, thanks, Deborah.
You're welcome.
Right, okay, so we now head south. We've got my colleague Brad Velkamp, who's next to speak in relation to US tax matters. Over to you, Brad.
Great, thanks, Andy. Appreciate it, and welcome everybody. Glad to have you with us today. You heard all my colleagues talking about a lot of changes to tax legislation related to COVID. US is, very similar in that area. We've had a number of different legislative acts, that have gone through since COVID has hit the United States. A lot of that has been around relief to individuals, relief to companies. Some of it has obviously been relief around taxes. And, that included, deferral of employers' Social Security. It included, relief to the individuals in terms of a stimulus check, and relief to companies in terms of, payroll protection, loans, and so on and so forth. So, additionally, as it relates to an individual who's, whether they're quote unquote trapped in the U.S. or trapped outside of the U.S. trying to get in. From a U.S. tax perspective, the U.S. did sit there and say 60 days, whether if you're in the U.S. and because of COVID, and you end up meeting, Deborah had mentioned the substantial presence test that we have here, that the U.S. would kind of exclude 60 days from that calendar count. Similarly, if you're out of the U.S. and you're trying to, meet the physical presence test to be outside of the U.S., but you're stuck in the U.S., they would kind of exclude 60 days that way too, so that you could get benefit of the foreign earned income exclusion. So, that there was some temporary relief that way. Unfortunately, 60 days has come and gone. And as most people know, people have been stuck a lot longer than just the 60 days. So that has led many companies to look at what does this now mean from a withholding perspective. Our colleagues in the payroll groups have been very busy helping, the companies address withholding issues, because of course in the U.S., it's not just federal tax that we have to worry about. It's, the 43 states that imply an income tax, not to mention the number of localities that also have an income tax. And each one of them has a very different rule around when withholding is required. And some are saying that they'll forgo some of that withholding because of COVID situation. Others are saying, too bad, so sad. We want our money because you're, working here now. So a lot of companies have had to address that. And I encourage everyone who has U.S. operations to fully understand what those withholding requirements are, so that you're not subject to, unforeseen penalties down the road. Moving slightly away from COVID, I kind of want to just talk about a couple quick, observations and trends that we see in the broader mobility space. Some of it is obviously impacted because of COVID. For example, cost-cutting measures. Obviously, in mobility programs, costs are always an important aspect, and everybody's looking for opportunity to, reduce those costs. But, because of COVID, cash is now king, right? Everybody's trying to find cash wherever they can. And a lot of that is coming down to, how do we take the cost out of our expat programs or mobility programs? And that could come through reduction in benefits. We're seeing a number of, obviously there's a lot less number of new assignments this year, of course, because people can't travel. So that's helping, naturally. One thing that we have been talking to our clients about is a regulation under Section 139 that allows for certain payments to be made to assignees tax-free because of the COVID situation. So, these things could be temporary housing or extra storage costs, but essentially, costs that would not have otherwise been incurred, but you've now had to provide them because the individual is not where they're supposed to be, and you're doing what you need to do under the program to support them. So a lot of that can actually be provided to them tax-free, which all right, there's still the cost of providing them that benefit, but now you don't have the tax impact, at least from a U.S. perspective. So just one thing to consider, if that's something that you're seeing a lot in your program, that's something you want to talk to your tax advisors about, and we can obviously help you understand when that section can apply. Something else we're seeing very getting a lot of chatter right now is around equity, right? As governments are looking at, okay, well, how do we turn the corner on tax revenues and start increasing our revenues again? After COVID relief, there's a lot of focus on the taxation of equity, and some of this stems related to business travelers, of course, but equity in as it relates to long-term assignments, just making sure that people have reported it correctly, and allocated that income correctly, and how do you ensure that the proper withholding is happening from the individual? This is a very time-consuming process, obviously, for companies to incur, and But there are solutions now out there that kind of streamline this and really help you become much more compliant about that. And then another area that we're seeing, and a lot of this kind of stemmed from, you know, a few years ago when the U.S. had its large tax law changes, you know, through back in 2017, and they took away the deduction around moving expense reimbursements. You know, those used to be able to be provided to individuals, and you know, the individual wouldn't have to pay tax on moving expense reimbursement. Well, now they have to. So again, that has increased costs to companies, and what a lot of companies are doing is turning to what I call self-service relocations, right? Where it's more of a, here's an amount of cash, and here's a website, go figure out how to get yourself from point A to point B and your goods from point A to point B. And they're just, you know, giving them the cash and sitting there saying, okay, great, we have a known cost and we don't have to worry. So, you know, that might be okay right now, and you know, from a tax perspective, because it works out to, you know, the same net cost. You know, but there are a few things that you need to consider with that, right? Is you know, your due diligence and care of your employees as it relates to that. So I'll kind of pause there. There's a few other things that are going on. There, you know, we could talk for hours of, you know, each one of us, but given that we're short on time, Andy, you know, are there any questions so far?
Yeah, so we've had a question that came in advance of today's webinar. Obviously, it's not gone unnoticed. There's a build up to a US election going on, and the question was just if there's any sort of non-political, needless to say, thoughts you have on the impact that the US election outcome could have on things like US tax rates and the pattern of international mobility.
Well, yeah, and I definitely wish I had a crystal ball on this, because it you know, make life much easier. But you know, in broad terms, you know, if the Democrats win, you know, control of the White House and maintain control in the House and win over the Senate, so they have all three arms on the political side, you know, it is quite likely that we would see tax rates go up, both at a corporate level, you know, because that was drastically changed under the Trump administration, you know, back with the 2017 changes, but then also at the individual level. Where it comes in at the individual level, I would expect it to be a lot more at the, you know, top end of the rates. You know, generally the Democrats sit there and say, if you're making a decent amount of money, you can contribute a little bit more to the general, you know, welfare of the country. So, you know, they'll look to kind of do that. You know, if the Republicans win, it's going to stay kind of status quo. I don't think they can afford to go any lower in rates right now, given all things considered, even though they would like to. But there's not enough political willpower right now to kind of lower the revenue stream from the government. So I would kind of expect more status quo from that perspective should the Republicans win, you know, either the White House or maintain a good lead in the Senate there. In terms of mobility, very quickly, obviously, any administration change is going to have a drastic, you know, impact on what happens from an immigration perspective. You know, the Republicans, and you know, especially under, you know, Donald Trump's administration, have been very aggressive with, you know, how they look at immigration, and you know, the way the Democrats speak about it. They want to loosen a lot of those restrictions that Trump has put in place. So should they win, you know, even just the White House, since a lot of what Trump has done has been by executive order, you know, should it be Biden and the Democrats in the White House, that could be, you know, undone with a stroke of a pen, you know, by Biden. So, you know, again, look for, you know, some modifications there pretty quickly should the Democrats take the White House.
Great, thank you very much for that insight there, Brad. So in terms of the last of the country presentations, all the way back to the UK here, and my colleague Stuart Strong is just going to speak on some of the trends and observations we've got from a UK tax perspective.
Okay, thanks, Andy. Like Brad said, we are running a bit short on time, so this is going to be a bit more of a whistle-stop tour than it was perhaps intended to be. We're just going to quickly look at some tax things, a little bit about what our clients are asking us about, and a tiny little bit on Brexit as well. So you've heard from a number of my colleagues about how their governments were quite proactive in terms of getting things done with respect to COVID-19. The OECD published their guidance on the 3rd of April. It took HMRC until 11th of August to publish theirs, and it was kind of met with a collective groan from the industry. There were very limited tax concessions put in, and in terms of the days that people are permissible under exceptional circumstances, no concessions at all. So you heard Brad talk about 60 days. 60 days is still the limit for exceptional circumstances in the UK. There was a small concession on national insurance, which gave a 6-week grace period with respect to people coming back into the UK from non-agreement countries. So they didn't have to start repaying national insurance until 6 weeks after their return. And then from a permanent establishment perspective, we have guidance which is largely consistent with the OECD guidance, which is that if the UK business activities are temporary and not due to commercial intent, i.e. due to COVID, then they're unlikely to pursue any permanent establishment issues. In terms of the UK budget, you've heard people mention budgets. Robin mentioned a budget today in the Netherlands. The UK is due to have a budget within the next couple of months, the autumn budget, but there are suggestions already that that may be delayed. And what might we be looking at from that budget? Well, the Labour opposition are pushing for an extension of the furlough scheme. The Conservative ruling party currently saying that won't happen. We're potentially looking at a rise in the capital gains rate, potential corporation tax increase, but that's got to be balanced with competitiveness of the UK in terms of Brexit. And then we're looking at potentially further restrictions to pension relief so that maybe only basic rate relief will apply in future. In terms of what our clients are asking us about, it's mainly to do with international remote workers. You've heard from all of my colleagues mentioning this. A lot of global mobility specialists are fielding questions now about individuals that are working all over Europe and beyond. And this is not just about tax, but employment rights, immigration rights, working hours, pay levels. It's quite wise for businesses to start thinking about whether there should be some sort of policy in place to deal with these international remote workers. And then you've got the choices of the business. Do you stand firm and say, no, we can't accept this? Or do you accept that the position is such that it has changed? We need to embrace change if we want to attract and retain the best talent. No right or wrong answer there, but it is something that all businesses should be looking at. The other slight issue is that individuals are starting roles before they can physically move. So, for example, if you were due to go on an assignment but you can't due to travel restrictions, so you start a virtual assignment instead, where you stay in your home location and you start working for an overseas entity. And then finally, just to cover Brexit very quickly, the situation seems to change on an almost daily basis. We were having a little laugh earlier about the seeming changes in Boris Johnson's mindset as to what he thinks he's going to be doing today versus what it will be tomorrow. So whether there will be a deal or not is now very much up for discussion. And what that might look like, again, is quite up for discussion now. One of the main issues that we see in relation to the Brexit piece, while the income tax position seems to be relatively solid because of the amount of double taxation treaties about, the social security rules, particularly with the EU countries, are a bit more difficult. So we could end up in a situation where we're having double liabilities, although we believe that the UK is still trying to retain existing social security rules. Andy, I'll pass back to you at that point. I know we're short on time, so do you have any questions for me?
Yeah, there's one question that again we had in advance of the webinar, and it's pretty useful to ask because it's relates to virtual assignments and the tax rules there. So this individual had asked, which country would we have to arrange income tax withholding in if someone does a virtual assignment for our Gibraltar office, but they're performing the work from London?
Okay, so yeah, I mean, I touched on virtual assignments a couple of minutes ago. So this is a situation where somebody is not moving to what would be the host location. due to travel restrictions. And if you've got a person that's physically based in the UK doing a virtual assignment for a Gibraltar entity, then that individual remains UK tax resident, and pay as you earn will be due, as well as national insurance. And what we would then advise beyond that is that the business needs to consider whether there should be a recharge to Gibraltar based on a transfer pricing perspective, and the paperwork that they've got in place in respect of this individual. So you can see what role the individual is performing, why they're performing that role where they are, and that will hopefully address the risk of a permanent establishment being created in the UK. So that's really the position, is that you need to get corporation tax input to ensure there is no PE risk, but ultimately the person physically present in the UK is going to be tax resident, and the withholding should continue in the UK.
Yeah, great. Thank you there, Stuart. So after everyone's spoken, thank you each of our colleagues from Overseas Office and Stuart from BDO London. Just some other general questions that we've had come in. The first one I'll put to Robin. So there was a question earlier, Robin, where one of our attendees had asked about the 30% ruling and those working outside of the Netherlands during COVID. Are you okay to address that point, please?
Yeah, sure. That's an interesting question, because there could be several consequences with regard to the 30% ruling in relation to the COVID. Well, first of all, the main rule is that the 30% ruling could be continued also during the COVID period. However, there could be all kind of situation, all kind of scenarios. One of the scenarios is that the employee is working from home outside the Netherlands for the Dutch company, and well, dependent on the fact whether there is a treaty or not, and dependent on the fact whether the employee chooses to have the taxation in the same pattern as before the COVID, it could be the case that the Netherlands do not have the right to tax the income relating to the days that the employee is working at home. In this scenario, the 30% ruling cannot be applied because of the fact, well, that the Netherlands do not have a right to tax the income at all. So then the 30% ruling is not applicable, and well, the local tax rule will apply. That's could be one consequence. Another consequence is we've got a lot of questions from our clients. Well, because that's relating to the duration, the possible duration of the 30% ruling. The maximum duration nowadays is 60 months, 5 years. And one of the questions is, well, in case the employee is working from home, let's say 6 months, can you reduce the duration, or can you reset the duration? So let's say to still make use of the 30% ruling after the original 5 years duration is over, because otherwise, well, you have not made use of the 30% ruling during the COVID period. Well, that's dependent on the situation. In very short, in this scenario, the main rule is that the Dutch tax authorities will have the point of view that in case the employee is still an employee of the company from a fiscal point of view, and the Dutch tax authorities have the point of view that in case you work more than 20 days in a calendar year, then you are still an employee of the Dutch company, then the 30% ruling cannot be continued after the 5 years period. So then, well, then you cannot benefit from a 30% ruling when you're working at home. That could be one of the consequences. So I hope this will give you, a clear view on the situation.
Thank you very much there, Robin. I'm conscious that Deborah is shortly to have to leave the call, so maybe if I could put a question to Deborah before she has to leave, which is, whether if you could give an insight into the establishment of a permanent establishment in a foreign country through the creation of a dependent agent in a foreign country.
Yes, on corporate establishments are usually looked at by what the person is doing in each country. It's not something I can really comment, mainly only on a high level, because it would be something that I would bring in our corporate people to help out on. But what we have seen is that you still have to look at the domestic rules based on what the people are doing in the country, and then go to the treaty. But what we've seen in some of the places is that the treaties are being overridden by the domestic rules based on what's happening. In some of the European countries, we've been hearing that. So what I would suggest is it's really a country by country combination that needs to be looked at, and you need to look at the corporate tax people to determine are the people that are being either stranded in your country or they're voluntarily, are they creating a corporate presence for the other company, their employer that is sending them there, or that they're stuck there for? So it's a matter of just having it looked at, because the rules are very different. And as we've talked about in some of the personal issues, the corporate issues are just as complex, and we don't want to have the corporate entity being brought into the tax net unexpectedly.
Thank you very much there, Deborah. That's greatly appreciated. Okay, I'll go to Stuart on this next question, and just to say, I'm conscious we've got about another 4 or 5 minutes to go. We'll probably run for maybe up until 4:10, and then we'll have a hard close on the call then. But Stuart, if I could ask you this next question, which is has been submitted. It says, due to staff still working from home, some staff contracted to work in the UK and on the UK payroll are working from other countries across Europe, for example, generally spending a month sometime more outside of the UK. What measures should be in place to ensure the company is in compliant? And it also said, if employees are doing this, is it better for management to know about it or not to know?
Well, okay, thanks, Andy. In terms of whether it's better for management to know about it or not to know, I think the answer is always yes, it is better for them to know. And the other important thing that you need to look at in terms of these people is that you need to get some sort of tracking in place. You need to understand what these people are doing when they first move to the location they're currently in. What is the plan for their return, and trying to keep on top of that, because obviously the goalposts are shifting as these rules change. But also keep an eye on the role that they're actually performing. These are the details that you're going to need in order to get the appropriate tax advice to make sure that you're not falling into any withholding pitfalls or social security pitfalls that you may be looking at. I mean, if the time spent is less than a month in the overseas location, it's quite unlikely to cause a tax issue. If it was more, what we would generally be looking to do is approach the overseas jurisdiction and try and get a view as to what they think the potential pitfalls are here and what the action is that is needed. If you're going 6 weeks out to 2 months, we probably recommend, if it's a European country, that you're looking to get an A1 in place. And then you also need to consider what the position is in terms of recharge of costs and whether that is appropriate from a transfer pricing perspective, and what that does to the income tax position as well. So those are the types of things that you need to be considering.
Okay, thank you very much there, Stuart. Okay, so there's a couple of questions for you, Brad. I'll maybe ask one of these and then circle back to you at the end for the second one.
Okay.
So, yeah, one of the people has asked, can you explain how we should handle the issue of individuals remote working in the US when their home state in the US is different to the US state that they would usually work in?
Yeah, so, I was alluding to that before. We have 43 states here that apply an income tax, and they all have different withholding rules. So, the easiest way to deal with that situation is call me, and I'll get one of our payroll team to call you back and give you the answers. But reality is that, Deborah was kind of alluding to it when we were talking about the PE. It is a situation by situation basis. You have to take a look at what state they were working in, what state are they now working in, and what needs to be done. Some states have allowed some softening of their withholding rules, others are clamping down on it. So it really does depend, and it is one where it is time to get some advice from the professionals.
Thank you very much there, Brad. Next, a question to Cyril. I know we've talked about some of the tax concessions already, but Cyril, it says where employees are displaced due to COVID-19, i.e. they are in a country in which they would not ordinarily be tax resident, are tax authorities likely to make any special concessions when it comes to tax residency status? Oh, I think you might be muted, Cyril. Oh, Cyril, are you okay to take off mute there, please?
Is it okay now?
Yes, yep, I can hear you fine. Thank you.
Okay, so on this question, first thing that the OECD released a report in April, and with commentaries on the OECD model tax treaty with regards to the COVID situation. And although it's not binding, it provides very useful guidance. And then it's what basically the issue is that the individual residence position in each country is determined first by the domestic law of each jurisdiction, and when we have an individual who is resident in more than one country, then the taxing rights or the tax residence would be determined based on the provision of the tiebreaker provision of the tax treaty, and as many tax treaties are based on the OECD model, I would say that the commentaries made by the OECD would be very interesting and very useful in this situation. The OECD gives some examples of some situation, and in both examples given by the OECD, the residency tiebreaker provision are likely to favor the normal country of residence due to the the interim and unusual nature of the temporary living in the country in which the people are stranded. And for example, in France, the tax authorities have adopted the same approach, saying that if a person is in France because of the COVID situation, it's considered as an exceptional situation. And because of that, this period would probably not impact the tax residents, meaning that someone who was in France during the lockdown period temporarily would not be considered as a French tax resident because of these exceptional circumstances. So as France, many countries have made some tax concession, and we have discussed some of them today, and most of these tax concessions are in line with the OECD commands, but again, of course, each situation which will be different, and it will be necessary then to analyze each situation on a case by case basis. But sure, there are some tax concession on the tax residence issue.
Thank you very much, Cyril. So we're just on to our last questions. Thank you for bearing with us while we cover these off. So the next question is to Peter. So Peter, I understand you've been liaising with the Belgian social security authorities about A1s in light of Brexit. Are you able to give us just an update on what you were hearing from the Belgian social security authorities?
Well, yes, of course, Andy. Well, the withdrawal agreement between the EU and the UK contains some provisions with respect to the continued application of the current EU rules, or the rules included in the EU regulation. And based on the interpretation of the withdrawal agreement, these rules will become applicable to all employees who are employed in an international or cross-border employment situation today. So people for whom an A1 has already been delivered or who start their international employment situation before the end of this year will continue to be covered by the rules in the EU regulation, even if they change their employment situation. So to give an example, an assignment from the UK to Belgium, for instance, that starts on the 1st of November of this year, will continue under an A1 for a maximum duration of 5 years. If after that period of 5 years, that individual will take up a new assignment in the Netherlands, then the EU regulation would still apply and would still allow this person to be covered by UK national insurance on the assignment to the Netherlands. So even though Brexit will obviously mean that the EU will leave the EU, the existing social security rules will continue to apply to all scenarios that are in place before the end of this year. Obviously, that does not mean that new situations as of the 1st of January will also be covered by the rules included in the EU regulation. That's where Mr. Johnson and the EU are still discussing and still negotiating what those rules will be. You all heard Stuart indicating that it is the UK's intention to still apply similar rules as the current rules. I believe it's also the EU or the EU's intention to put similar rules in place. So we may find ourselves in a position or a situation where EU and UK reach an agreement to continue the application of the EU regulation. It's not that far yet, but all situations in place before the end of the year will be grandfathered. That's something that we already know.
Okay, thank you very much, Peter. So, sorry, just to end off with the last question that came in from one of the audience members. So it says, have a US employee stuck in the UK and have been for 6 months because of COVID, should we continue to withhold social security taxes given the employee is still on the US payroll? Unfortunately, the employee did not anticipate getting stuck in the UK. So just before I hand over to you, Brad, I'd say from a UK perspective, they may be approaching 183 days under the treaty, so there may be an income tax issue. Brad, do you want to comment on the social security issue from the US perspective?
Yeah, so very quickly on the Social Security side, if the individual is maintaining the same role as they had in the U.S., so all the services are benefiting the U.S. entity and is legally therefore still employed by the U.S. entity, then a certificate of coverage should be applied for to basically lock in place the U.S. Social Security and avoid any or any needs to have UK Social Security being withheld. But as Andy said, on income tax perspective, if it's been 6 months, it sounds like we're getting very close to 183 days. So we may not be able to avoid UK income tax implications, which would offset US obligations to avoid double taxation. But there could be some filing requirements there.
Thank you very much there, Brad. Greatly appreciated. Well, look, apologies that's gone on for 10 minutes beyond our scheduled time, but I hope you found it useful both to hear the presentations by my colleagues and also their responses to the questions that were posed both in advance and during today's session. So thank you very much for attending. We will be circulating some notes of the issues that we covered in today's series of presentations, and we'll be doing that alongside a recording of the presentation, so that will follow to you hopefully by the end of this week. That will also include contact details for my colleagues that have spoken in case you wish to get in touch with them directly. And at that point, I would like to bring things to a close and to thank my international colleagues for making themselves available as well. Thank you.
Bye, everybody.
Bye-bye.
Bye, everyone.
Bye.